So, for those of you who were here last week, welcome back to the New Ideas in Insurance Law workshop. Today we have Ken Abraham and Dan Schwartz presenting their paper, The Mirage of Regulation by Insurance. And just a reminder on the format, so we're going to have them present for 30 to 45 minutes, however long they want to go. And then I will keep a queue. If you could, you can use the little hand raise function. If you don't know where it is, it's on the bottom of your screen. There's a little reactions button. It's a smiley face with a plus. And then if you click on that, there's a button in that menu that will pop up called raise hand. And if that doesn't work for you, you can just send me a direct message and I'll put you on the queue. The only other thing I'll add is that this session, like other sessions, is going to be recorded unless and then circulated after the fact unless the presenters request otherwise. And next week we have Justin Sidner of the University of Wisconsin-Madison School of Business presenting his paper, Why Health Insurance Customers Make Bad Choices. So with that, I'll hand it over to Ken and Dan.
Thank you, Travis and Peter. Our paper is about the limits of insurance as a device for regulating safety and promoting loss prevention. So Dan, you can move to the next slide. These slides are basically outlines of the paper, and we're not going to just read the slides. The slides sort of track what we're going to say, but as I say, they're basically just an outline of the paper. So here's where the paper fits in the evolution of thinking about insurance. Insurance creates moral hazard, the tendency of anyone who is insured against a loss to exercise less care to avoid causing the loss than would be exercised in the absence of insurance. This poses a problem for both insurers and for public policy. For insurers, moral hazard poses pricing problems, and for public policy, moral hazard creates the risk that losses that are otherwise worth avoiding will nonetheless occur. The classic understanding is that insurance can combat moral hazard using two main devices, partial insurance or loss sharing and risk-based pricing. Risk-based pricing gives insureds the incentive to reduce their risk of loss and save money on premiums, and partial insurance functions to give insureds skin in the game. If I'm going to have to pay for part of an insured loss, then moral hazard is reduced. In recent years, there's been a burgeoning literature about this, some of it observing that there are additional ways in which insurance combats moral hazard and thereby regulates, I would say, in quotes, as it were. We call this literature, lumping a lot of different things together, the regulation thesis. And in line with the regulation thesis, there have been proposals to mandate or promote the purchase of insurance in order to engage insurers in the regulation of such behavior as gun use, police misconduct, cyber attacks, and harm caused by artificial intelligence. Some of this work, a lot of this work acknowledges that insurance usually has what Dan and I call, a net negative impact on loss, that insurance creates moral hazard, but that it can be combated more than is sometimes thought. Some of this work, however, makes a stronger contention that sometimes insurance can make things safer than they would have been in the absence of insurance. We call this the contention that insurance can have a net positive impact on loss prevention. Our paper is critical of the strength of both these kinds of claims, although I should say that not every article makes every claim by any means. We argue that devices for combating moral hazard reduce the net negative impact of insurance less than proponents of the regulation thesis contend. And we argue that insurance will rarely be able to have a net positive impact on loss prevention. That is, insurance will rarely be able to make things safer than they would have been if there had been no insurance. Next slide, please, Dan. The paper has 4 parts. First, a survey of the theory and evidence about insurance and moral hazard. I'll talk about that. Then we have two parts explaining why the evidence supports our position, or the lack of evidence supports our position. Part two, sorry, is about what we call the conventional devices for combating moral hazard, including risk-based pricing and partial insurance. And part three is about the unconventional devices, including direct insurer involvement in loss prevention with their policyholders and action directed at other forces, such as the development of safety technology and support of safety legislation. Dan will talk about parts two and part three. And finally, part four tries to capture the lessons of our analysis, and I will summarize that. Next slide, please, Dan. So I'll start with theory and evidence. I've already summarized the core of traditional theory, which is that moral hazard can be combated with a series of devices that are essentially internal to insurance policies and the insurer-insured relationship. Risk-based pricing creates incentives for insurers to optimize their losses. Basing premiums on observable features of an insured or its operations, feature rating, such as whether an insured industrial property is equipped with fire-combating sprinklers, creates safety incentives. And basing premiums on the extent of past losses gives the insured an incentive to figure out how to reduce losses and to consider doing so in order to save money on insurance premiums. Similar incentives can be created by partial insurance, by policy provisions that exclude coverage of losses that are especially likely to be influenced by moral hazards, such as losses that are expected to occur. And its incentives or loss prevention itself can be created by ex post loss management, in which, for example, the insurer in a liability policy defends lawsuits and employs its expertise to defeat suits or limit liability. The new literature, or the regulation thesis literature, also identifies unconventional techniques for combating moral hazard that insurers employ, including coaching insurers about how to reduce losses and helping develop safety manuals for them. But there's also some recent literature, theoretical literature, suggesting reasons why these conventional and unconventional devices may not succeed. Peter Siegelman, one of the co-hosts here, and his co-author Gideon Parchamovsky have identified one such phenomenon, which they call third-party moral hazard. This is the incentive that insurance creates for wrongdoers to threaten policyholders in order to extract insurance benefits from them. Kidnapping insurance, they argue, may promote kidnapping because the insurance makes it more likely that the insured will pay a ransom. And cyber insurance that covers payments to hackers who have installed ransomware in an insured's computer system may increase the likelihood that the insured will pay to have the ransomware neutralized. An additional critique comes from a paper by Ronen Avraham and Ariel Porat, who argue that it is not in insurer's interest for aggregate losses to decrease over time at all, but for aggregate losses to increase in order to fuel the demand for insurance. Consequently, they argue, insurers promote increases in aggregate losses in various ways and then simply compete by attempting to combat their own insured's moral hazard and thereby increase their own profit. So for Avraham and Porat, these differences and these different forces and incentives are working in two different directions, some to promote loss and others to reduce it. That's the theory. Now, as to the evidence. First, most of the evidence is qualitative, not quantitative. And the qualitative evidence, some of which is really just informal sampling, is spotty and very mixed at best. Ex post moral hazard can be reduced by partial coverage in health insurance, but sometimes at the expense of long-term health. Risk-based pricing and workers' compensation seems to influence loss prevention. But there is no persuasive evidence that in conventional commercial insurance, techniques for combating moral hazard have highly significant impacts on loss prevention. In cyber insurance, for example, the evidence shows that insurers' putative devices for combating moral hazard have little effect. And in D&O insurance, insurers make little, effort to influence the quality of corporate governance, which is the principal underlying determinant of corporate liability. In fact, the persuasive evidence that insurers substantially impact loss prevention is found only where there's genuine mutual insurance or niche insurance. For example, in police liability insurance, where intergovernmental risk pools rather than commercial insurers dominate the market. And the same is true in legal malpractice, where the dominant insurer is a genuine mutual insurer that gets a significant amount of input from its policyholders. What appears to be going on, as Dan will indicate, is that the expertise of these mutual and niche insurers and the trust that they engender in their policyholders gives their loss prevention recommendations both greater effectiveness and greater persuasiveness. And a niche insurance such as, and I mean real niche insurance, such as maritime insurance for Arctic shipping, something analogous occurs since there's a small number of maritime insurers insuring Arctic shipping operating mainly out of Lloyd's, and they appear to share their expertise. So the question is, why is the regulation thesis largely a mirage? What are the factors that confound both the efforts of conventional and unconventional devices for combating moral hazard from being more successful than they are? For that explanation, I turn it over to Dan.
Great. Thanks so much, Ken. We, as Ken mentioned, we divide the world up between conventional and unconventional loss prevention mechanisms. And the way we think about this is conventional loss prevention mechanisms are really mechanisms that insurers have to use in order to transfer risk. Okay, so we think about a few sort of traditional loss prevention methods in this way: risk-based pricing, partial coverage, exclusions, ex post loss. All of those really involve sort of essential insurance functions really that are necessary to transfer risk: the pricing of risk, the delineation of what risks are transferred, the actual process of paying out claims. So that's where we want to start. And we want to understand, okay, well, what are the barriers to these mechanisms to actually preventing losses? So we want to start out with risk-based pricing. And we divide the world up in risk-based pricing into two sort of fundamental features. So the first is feature-based rating, right? This is the process where you go to the insurer and they get a lot of information from you about certain elements of your operations, about certain elements of your risk, and then they link rate to that risk level. And there are, again, the literature here is quite large, but I would say that many folks have said, look, this is an important way that insurance can reduce risk. And to be clear, insurers sometimes do this, right? There are examples of maybe an insurer is going to give you a discount if you have a sprinkler for fires, or if you have an alarm system, or if you use a particular type of barrel to prevent pollution. But what we suggest is that there are a lot of really important obstacles to feature rating accomplishing that regulatory objective. And in fact, the main reason why insurers use feature rating is not really about moral hazard at all. It's about pricing risk accurately so that they can make a profit and potentially limit adverse selection, though, as Peter has written, sometimes even that risk is exaggerated. So why is it that feature rating is not often effective and not often used, at least based on what we think the literature shows empirically, in terms of actually reducing risk as opposed to accomplishing other objectives? Well, the first piece of that is, in order for actual feature rating to improve riskiness, what you need to do is you need to identify some feature that has a causal relationship to risk. So you need to say, look, if you have a fire alarm, that then is going to reduce your risk of actually having your house burned down. And the difficulty there is that, sure, there are some precautions that we can be pretty confident have a causal link to risk. But in many cases, the causality is difficult to determine. I mean, as all of us know who have looked at the empirical, figuring out causality is immensely difficult to figure out. And also, that's not actually something that insurers even try to do most of the time. That's not within their sort of core competency. I mean, actuarial analysis is about correlations. And at least historically, and sort of the methods of actuarial analysis, they're not looking for causal relationships. So even when you see certain features being priced, you can't necessarily know that the reason why there are correlations with, say, whether or not you have an alarm system is because people who have alarm systems are less likely to have a burglary. I mean, it might very well be that actually this is just indicative of some larger piece of information that's unobservable, right? Maybe you're just more careful person in general, and that's why you have a fire alarm system. And if that's true, then feature rating isn't actually going to trigger loss prevention. The second piece is an important one, which is insurers are very careful to safeguard their information that they develop and how they underwrite and rate. They go to immense lengths to keep this confidential because essentially this is the technology of insurance, right? This is how they compete. And so if they are competitors to learn this information, they can be undercut. And it's even worse than that. They can actually potentially be undercut in ways that allow competitors to sort of steal away good risks. And so the difficulty is that many features that might actually not only be correlated with low risk, but actually cause lower risk are ones that if the insurer discovers, it's not going to want to advertise. It's not going to want to tell everyone, hey, here, if you do this, your risk is going to be decreased, because that actually can undermine their competitive advantage. And if you look at just how insurers operate in most settings, they're incredibly reluctant to be forthcoming about what types of factors they consider in their rating and their underwriting, unless that's legally required. And so what that means, again, is if policyholders don't know, or applicants don't know, whether or not they're going to get some discounted premium if they engage in certain behavior, then you're not going to impact their behavior by pricing coverage in a certain way. And that also is an impediment to insurers using feature rating to limit risk. Third, there are a lot of settings in which an insurer might be able to sort of say, oh, gee, well, if you use this precaution, it will limit risk. But the difficulty there is that in order for it to actually be effective as a precaution, it needs to persist throughout the policy period. And in certain instances, that is just very hard for insurers to observe. So one anecdote about that in cyber insurance is that many insurers are saying, well, we'll give a discount to folks who use multi-factor authentication, which is the bane of my existence, and I hate it, but is also very effective at preventing ransomware attacks and the like. Well, what often ends up happening is that folks sort of implement the MFA right out the gate, and then what you hear is that everyone's sort of bypassing it. And so this is yet another obstacle to insurers using this effectively. Finally, there are, of course, just many features that policyholders can't control that are going to be relevant to risk. Now, to be clear, again, we're not saying this never happens. Of course, it happens sometimes. But what we're saying is that the use of feature rating to actually effectively limit risk is much more difficult than is sometimes suggested. And this is an important point. Where it is used, it is often used for sort of simple, intuitive precautions that everyone knows about, right? I mean, I guess we can all stipulate having a smoke detector makes you let your house less likely to burn down. And so maybe your insurer will offer you a discount for having a smoke detector. But when one then reflects on some of the claims that insurance can have a net positive effect, many of those claims are premised on the idea that insurers have superior risk-based information that is not available to policyholders and can leverage that information using feature rating. And what we would say is, to the extent that you're dealing with precautions or adjustments that are not intuitive, that are not well known, that's exactly when some of these, in particular, I would say number two, the insurers are going to be least likely to want to broadly communicate that, because they're going to have to invest in learning that. So this helps in our mind explain why feature rating is often not effective, is often not used, and when it is used, is often tied to simple, intuitive precautions that are sort of well known. How about experience rating? So experience rating is different, of course, and I'm going to have to get going a little faster, I'm noticing, in order to, Peter, how long should we go talking before we start going to Q&A? What's our sort of ideal time frame here?
Travis is in charge. You can do, as far as I'm concerned, you can do whatever you want.
I mean, if we can leave 15 minutes in the end for Q&A, that'd be ideal.
All right, well, I'll try to go a little bit faster then. So Experience rating is this idea that, we're going to change your premiums based on whether or not you have a claim or you have something related to a claim. And to be clear, this works well in some settings as well. The empirical evidence really is very strong on this in workers' compensation. But here too, there actually are some really sort of fundamental impediments to this working broadly. So the most important, I would say, is that in order for experience rating to work really well, you need a scenario in which policyholders are willing to trade off essentially immediate costs now for future and uncertain gains. Why uncertain? Because no insurer commits to lowering your premiums if you have safety, and no insurer even necessarily commits to raising your premiums if you have a loss. It's sort of a big set of uncertainties. You don't know exactly what's going to happen to your future premiums, even if your insurer says they experience rate. And there are actually a lot of factors that can affect your premiums that are not even related to your potential losses. The second piece of this is that in some contexts, it's not actually even clear that losses in one period are actually predictive of losses in a future period, which then leads insurers to not even use experience rating. So the big example here is medical malpractice insurance, where many mid-mal insurers don't even experience rate. But I think another setting in which this is true may very well be cyber insurance, because oftentimes what happens in cyber insurance is if you're hacked, then you see your vulnerabilities, you have a crack team that comes in and sort of really safeguards you. And so in some sense, at least in many contexts, the safest potential policyholders are the ones who have most recently been hacked. And so you can't actually use that loss experience to experience rate. A final point is just for certain insurers in certain contexts, you may not necessarily need to purchase future insurance if your premiums go up. You might just choose to self-insure. And so then that too, the risk that your premiums are going to go up by a large extent is going to limit the effectiveness here. Now, just to say one more thing before I move on, because risk-based pricing, I want to spend some time on it because I do think it's a really important element of where you see claims about loss prevention. There are clearly contexts in which this works, and I think they're illustrative. So workers' compensation, legally required. There's an immediate benefit to reducing your risk of an accident at the workplace because then you're actually boosting more employee morale, right? So it's not just about the insurance payouts. And workplace accidents are sufficiently common and sufficiently predictive that you can have experience rating. So I think these factors help explain where we see it, but they also help explain where it's much more difficult. I'm not going to spend too much time on loss sharing. I mean, I think the evidence is pretty clear that if you have things like deductibles and co-payments, that can affect the extent of moral hazard, though they really can't produce a net positive effect because all you're really doing is removing insurance coverage and removing the source of moral hazard. The other thing I would just note here is that oftentimes when you see loss sharing, it may be serving purposes other than reducing moral hazard. It may, for instance, be limiting coverage for small losses, which are just administratively not worth paying, or it may be doing other things as well. But again, no doubt that in some contexts, loss sharing reduces moral hazard. We don't want to dispute that claim, but we just want to sort of put it in context that oftentimes you don't see as much as you might think, and oftentimes it's not serving that purpose. It's not necessarily serving that purpose to the exclusion of others. Coverage restrictions. So this is one element of conventional loss prevention that you see people talk about a lot. And the idea here is that if your coverage is conditioned upon you taking certain precautions, or if there are certain exclusions associated with a failure to take precautions, that's going to influence care. And here too, we think that there's some theory behind that, right? I mean, and theory even for that potentially producing a net positive effect. Maybe your insurer knows that some particular behavior is really effective in reducing risk, and so it conditions your coverage on you taking that behavior. But we think a really important consideration here that is oftentimes overlooked is the fact that coverage restrictions and exclusions can only influence behavior to the extent policyholders are aware of it at the time they make the risk relevant decision. And in a lot of contexts, that condition is simply just not going to be met. You may not know the terms of your homeowner's policy or your terms of your D&O policy or what have you at the time you're making decisions about whether or not to take on a risk. Now, again, there are important exceptions, there are important contexts in which that's not true. And one of the most important that we want to highlight is that to some extent, if there's a condition that you can that you're made aware of at the time you purchase coverage, right? Your insurer makes you aware of it, the agent makes you aware of it. You can then proactively implement precautions to attempt to avoid doing that. So, we use an example in the paper of, well, I won't go through the example, but you can see the point here. So again, it's not that this doesn't work, it can work, but our point here is that it can only work under certain circumstances as opposed to having this broader sort of, a robust effect. How about ex post loss management? We think this can be quite effective at limiting ex post moral hazard. And here we think that part of the difference is that you're very much aware of your insurance at the time that you have a loss. But again, we actually think that means that it's less likely to have this net positive effect that some people suggest. Because even if you don't have insurance, if you have a loss, then you're actually going to be on you're going to have pretty good incentives if you bear the full costs of that loss to take certain precautions. And so while it is surely the case that insurance mechanisms to limit ex post moral hazard limit that phenomenon, we don't necessarily think that it produces more care relative to a situation in which you don't have insurance at all or where you have less insurance. The other point we just make is that in certain circumstances, insurer loss prevention mechanisms really do more to shift losses onto third parties or even onto policyholders than necessarily to reduce loss. Okay, so let's move to unconventional loss prevention mechanisms, because these are clearly an important part of the story. And again, how we're going to define these as mechanisms that operate outside of sort of what is necessary to transfer risk, to effectuate the core of the insurance relationship. So we divide this into two sort of categories. The first category is direct insurer engagement with the policyholders. And there's been, a lot in the literature describing different ways that this can occur, whether it's insurers sort of, helping policyholders develop sort of policies to reduce risk, or helping to develop employment practices, or helping to develop problematic employees, or providing training, or providing hotlines, or what have you. There's a wide range of ways in which, again, this can happen, this does happen. We don't mean to be claiming this never happens. What we want to suggest is that it's the conditions under which this can be effective, and in particular when it can be profitable for an insurer, are much more limited than is sometimes suggested. And that again feeds back into our claim that a lot of times in sort of conventional insurance markets where you have sort of profit-seeking insurers, they just forego this. And so the first thing to recognize, of course, is that this is just costly for insurers, at least if it's going to be effective. Now, one thing to note here, and I do think it's important to note, is what's not costly is to say you do this in order to market the benefits, right? Insurers market all the time that they reduce losses, right? And we do think sometimes people have given too much credence to those claims, because of course they have an incentive to say that reminds people of the benefits they have. It frankly can be actually a mechanism to attract good risks, but that's a very low cost sort of potentially, and we haven't seen any evidence it's effective when insurers sort of sends you some pamphlet, right? Hey, here's how to prevent home fires. Great, that goes in the trash. Now, if you're going to be talking about customized services, right? Customized, that can be effective. And again, we think the literature shows that, but it's costly. And the reason why it's costly is it's provided free to policyholders, right? Otherwise, policyholders won't take it. So we're talking about providing a free service to your policyholders. Now, of course, you can just charge higher premiums for that. But the difficulty is that there's very good evidence that most people don't, purchase more expensive insurance because it comes with loss prevention. When you look at, polls of brokers and surveys of brokers, and you say, how do you choose insurance? The last thing on their list is loss prevention. And the first thing on their list is cost, right? Maybe solvency as well. But loss prevention is very low down. So that's sort of the first thing just to sort of take stock of. But the second real piece that we think is oftentimes underappreciated is the fact that to the extent these loss services work, in a lot of cases, they can be appropriated by competitors or by policyholders. I mean, if you succeed in reducing the risk profile of an insured, at least in any way that is prolonged or likely to continue, well, you either have to charge lower premiums to that insured and get lower money, or they can go out in the market and go find some other insurer that will do it, or they can self-insure. So the difficulty here is that an insurance policy is a one-year contract. And most precautions, to the extent they're going to be effective at reducing risk, do so on a time frame that's much longer than a year. And so it's very hard for insurers to capture the full benefits. Now, again, this doesn't mean this never happens. And I think there are some precautions that are less about long-term precautions and more about sort of immediate risk. And that is where I think you see the more success here. So maybe a hotline, right, to give you advice about what to do in a particular instance. You do see a lot of reports of that. And I think part of the reason there is that's providing immediate benefits that don't last into the future and thus are harder for insurers to appropriate. A third point here is one I won't belabor. Actually, Kyle Logue, who's sort of written on both sides of this issue, but Kyle Logue has a really nice paper exploring the fact that actually insurers that engage in aggressive direct engagement with policyholders potentially expose themselves to tort liability. And part of the reason for that is well, Ken is more of a tort expert than I am for sure. But once you affirmatively volunteer to help someone, you have a certain duty of care to do so effectively. And insurers are regularly held liable for this. And then when you talk to insurers about whether or why they engage with policyholders, this is something that they regularly bring up. The fourth point, and this is one that is developed in a lot of work by, I think Tom Baker and Sean Griffith, their work on D&O insurance. I think Marcus, who I think is on this call, developed this in the context of municipal liability insurance. But it's something you see in a number of settings. I think you see it in the cyber insurance setting as well, which is a lot of times policyholders don't want these services. Even if you're giving them for free, they don't want them. They view them as disruptive. They view them as the insurer telling them what to do. They view them as just something that impedes their ability to get stuff done. And if you're competing to sell a product and then you're saying, but also, if we sell you this product, you're gonna have to allow us to annoy you a lot and give you long seminars that no one wants and review your policies. I mean, that's a competitive disadvantage. Okay. And so in many settings, that can really have an effect on insurers' willingness to provide these services or insist on these services. Now, that doesn't mean they won't offer them as an add-on. Sometimes they do offer them as an add-on. Hey, if you want this, we'll provide it for you. But then now we're talking about, some voluntary thing that a lot of policyholders won't necessarily take up. And it also doesn't mean it never happens. And again, here, I think it's useful to go back to the fact that the literature where it does establish the more robust mechanisms oftentimes is focusing on more of those niche markets or mutual markets where there's this level of trust between policyholders and insurers, and where maybe policyholders are more willing to say, insurers, you understand us because in fact you are us, and so we want you to take the lessons and teach us. But in a lot of contexts, that just doesn't work. Final point, and then I'm going to turn it back over to Ken. And let me just make sure I think we're doing okay on time. So the other sort of element here, the other bucket besides direct methods by insurers to limit risk by engaging with their policyholders is insurer efforts to affect risk more globally, right? To affect public policy, to produce data, to produce technology that can, increase significantly or improve significantly the risks that are faced. And the difficulty here is that at the end of the day, those types of efforts are public goods, right? Meaning that at the end of the day, they produce benefits that are mostly not captured by the insurers who invest in those efforts. Now, that doesn't mean, again, right, we want to, be cognizant of having these caveats, right? It doesn't mean it never happens. Of course it happens. There's some very good and powerful examples. Auto insurers, for instance, have been very instrumental in promoting safety of autos. But why is that? Well, the reason why that's the case is because in order to overcome a public good problem, of course, you need collective action. And collective action can work if you have a lot of unanimity among the industry regarding what makes sense for the industry. But the difficulty is that in many settings, you're not going to have unanimity or even anything close to unanimity regarding the appropriate public policy or regarding the appropriate investment in safety initiatives. And part of this I think these 2 points here are linked, but at the end of the day, reducing risks can actually reduce long-term demand for insurance. Ken referenced Ronan Avraham and Ariel Parat paper on this. We have some quibbles with the paper. But that being said, we think that there is something there. And by the way, there are other people who have made this point before, right? Which is there are settings in which reducing risk in the long term is a negative proposition for insurers because it reduces demand for their product. Now, again, there are always caveats here. There are always settings in which this doesn't work. So let's look at where this has worked. In auto insurance, why has this worked? Well, you get unanimity among insurers that it's good to have increased auto safety. Why? Well, auto insurance is mandated, right? So you have sort of guaranteed a demand for the product. And at the end of the day, that guaranteed demand can at least go part of the way towards explaining why there's coordination here. I think it's helpful to consider a contrast here. So let's think about global warming and property insurers. In my mind, and I think the evidence is pretty strong here, property insurers have done very little relative to what they could do to limit risk. Why? Well, there are a number of reasons. One is that global warming and the associated risks are more long-term, and insurers issue year-long policies. But I think another reason is that insurers don't see eye to eye on this about what is in their long-term interests. Some see it in their interests to address this and to spend a lot of money on it, but others don't, precisely because if the risks increase, they can just leave. They can just stop writing business in the area. And so even though, there's a paper out there by Dave Jones, the former California Insurance Commissioner, showing that, if insurers wanted to, they could implement measures to debulk forests and engage in forest management that could reduce premiums by 40 or 50%. And yet they haven't. And part of the reason why they haven't, I think, is that it's not clear that it's in their interests. And even just that lack of clarity then means that overcoming this collective action problem is very, very difficult. So I'm going to turn it over to Ken to talk about our final section of our paper, and then we look forward to Q&A.
Thanks, Dan. You can show the whole slide if you want. Now I will provide what we think of as a theoretical and conceptual synthesis. If you read the paper, you know that we start with what might look like a vocabulary lesson, but we think that our analysis showed that keeping concepts straight is essential to accurate analysis. So we think that there is a distinction, Dan made reference to it, there's a distinction between devices that combat moral hazard and devices that avoid creating moral hazard in the first place. Risk-based pricing combats moral hazard, but partial insurance, loss sharing, is actually partial non-insurance. It avoids creating moral hazard or some moral hazard in the first place. Similarly, all the devices involved in a certain attenuated sense involve loss prevention, but calling all this loss prevention, calling it all regulation, is unhelpful. Creating less loss than would otherwise have been created is not loss prevention in the sense that proponents of the regulation thesis often use the term. And in any event, it can be misleading to call devices that help insurance create less loss than it otherwise would have created regulation. Calling the party that generates a risk of loss a regulator, even when that party generates less risk than it could have generated, has a certain figurative or metaphorical appeal, but it's too likely to be misleading. Beyond conceptual or definitional clarification such as this, we think that our paper reveals that whether insurance can combat moral hazard and how much it will do so is a function of three factors. So this is a sort of synthesis of parts 2 and 3. The first factor turns on the costs and benefits to policyholders of engaging in loss prevention. We saw that sometimes, perhaps often, the game just won't be worth the candle because loss prevention is too expensive or because premium savings just won't justify any or much additional loss prevention. So moral hazard is created and remains. The second factor is information. For policyholders, insurance is not going to combat moral hazard if policyholders cannot cost effectively determine what risk mitigation efforts will cost and what particular dollar benefits they will generate. The world is full of situations in which information about these factors is imperfect or non-existent. For insurers, the same is true. They need to be able to determine what efforts may decrease policyholder losses. When they do not know that to any great degree, then they cannot employ devices that will help combat moral hazard. And the third factor is the costs and benefits to insurers of deploying devices that may combat moral hazard. As we say, insurers may find it costly to do this, especially when these efforts can be appropriated by competitors and when increases in aggregate loss over time will actually redound to the benefit of insurers. The combination of these three factors helps to explain why the evidence supporting the notion that insurance can be an effective regulatory device is limited, and why proposals for mandating the purchase of insurance in order to enhance safety are usually unrealistic. A final and important point is that however successful devices for combating moral hazard are at reducing the net negative effect of insurance on loss prevention, the evidence that insurance can have a net positive effect on loss prevention is thin or non-existent. The proponents of the regulation thesis who recommend that the purchase of insurance be mandated in order to make things safer than they would be in the absence of insurance do not have much persuasive evidence supporting that. Why? Well, if the devices for reducing the net negative effect of insurance on losses are only as mildly successful as we have shown they are, then a fortiori, these devices are unlikely to have a net positive effect. As we say in the paper, without using Latin, you have to walk before you can run, and insurance does not even walk very fast. All this might be viewed as a pessimistic story, but we actually think it's positive. Insurance is almost always welfare enhancing, just not as welfare enhancing as the regulation thesis contends. And we're all in favor of effectively combating moral hazard and promoting loss prevention when it can be done. We just don't think that it can be done nearly as often as the regulation thesis contends. This shouldn't be surprising. Step back from it all. In a fundamental sense, the purpose of insurance is to encourage risk-taking that would not occur in the absence of insurance. And once you encourage risk-taking, then along with all the positive effects of doing so, an increase in the losses that risk-taking risks is naturally going to occur. That's what insurance wants, and that's what it's going to get. Thanks.
All right. Thanks, Ken and Dan. So we're going to open up for questions. Again, you can use the little raise your hand feature, and it's been I've been reminded that if you can't find it, it's also available on the participants column. If you hover your mouse over your name, you'll see a little hand pop up. So first on the queue is Omri Ben Shahar.
Well, I had a chance to read the paper before, and thank you for summarizing it for us. I guess I'm one of the villains here. You cite a lot my work with Kyle Logue that promotes the insurance as regulator idea. And I accept a lot of your pushback. I'm not, if anything, I'm not going to be defensive here. I'm going to be a little bit offensive. I guess my view about this issue was we wrote a paper as a proof of concept. Here's something that can happen, sometimes happen. We don't know for sure how much it happens, but hey, let's notice the potential for it. I think the test that you took upon yourself is much more difficult. A proof of non-existence, that this does not work. And especially Ken's concluding remarks are so kind of almost ideological. So I'd like to alert you to two things that you pass a little. It almost feels like you're hiding the ball, and I would urge you to change a little bit, maybe the tone or the measure, and to pay attention to them more specifically. So when you talk about experience and feature rating, on page, what is it? I'm looking in the paper. Other people might not have it. Page 25. You mentioned two things. in passing and say, yes, you gave us all the arguments that you gave here as to why this doesn't work. Feature rating, experience rating don't work that well in regulating behavior and leading to net gains. But you qualify that in passing in one kind of, here's a sentence. Another option is for insurers, you say, to use technology that directly tethers rates on ongoing policy holder behavior as they do, and precautions as they do in pay as you drive auto insurance. Now, this is the big elephant in the room. The evidence here is not spotty or thin or non-existent or misleading. Evidence is dramatic and misleading and repeated. That telematics, pay-as-you-go, like the mechanisms introduced by Progressive Insurance and now by many other, including automakers like Tesla, reduced fatalities in an enormous rate, far and beyond any precaution ever installed or mandated by lawmakers or automakers. A paper published in 2020 in the Journal of Law and Economics estimates the rate of fatalities to reduce by 50%. I think that's an overestimate, but other empirical studies that are done pretty well and peer-reviewed, count them as evidence, show dramatic reduction. I don't want to take too long. I'll just give another example. In the same page 25, you acknowledge that persistently high insurance rates for certain activities may become general knowledge and influence decisions on whether to engage in the activity. True, not necessarily on precautions, but activity. I'll just mention that I think that's a really key aspect of regulation by insurance, giving people signal as to how costly their behavior is. If the state of Florida were allowed home insurers, property insurers, to charge real rates for the risk, the coastal region of Florida would not have been developed. Possibly, Kuhn-Reuther has an estimate on that. Logan and I have a follow-up paper on that. It would seem to have a dramatic effect on willingness of people to pay, to move into areas where if instead of paying $1,200 a year, they would have to pay $5,000 and $10,000 a year to live close to the water. So these kind of signals of risk that you give to pay through premiums may have a significant effect in this. So I mentioned auto and property. I have other examples, but I'll stop at that.
Well, I'm sure we'll probably both want to respond. We certainly don't think of you as a villain.
I do.
And, the academics here understand, but just for the students who are listening, I think that you and Kyle pushed the ball forward, and we're trying to push it further forward. I think your telematics point we have on our list of things to adjust in the paper. So the telematics point is a friendly amendment. As far as the activity level effect, I think the question is, not whether theoretically in some ideal world insurance could have more effect, but whether it actually does. And we go back and forth between theory and how things work too. That's to some extent a friendly amendment. But for the students, what you need to understand is that there's a kind of a small group of, I don't know, a few dozen insurance law scholars in the law schools who are publishing, and that Omri says to us, well, maybe I'm a villain here, but he's been a co-author, right, of Dan's, and Kyle, his co-author, has been a co-author of mine, and so we're not enemies, and people aren't villains. We're trying to push forward the frontiers of knowledge, and sometimes we're critical of what one of our former co-authors wrote. So that's the intellectual context in which this takes place. So Dan, you go ahead.
No, so thanks. So I'll say this. First off, I do think, it is true that to the extent we have sort of one paper that is sort of the most prominent and has been in pushing it, it's yours and Kyle's. And to some extent, we focus on it because it's been so influential. And we think a lot of it is right. I think that in terms of whether it's a proof of concept or it's a more a sort of suggestion of this can work, there are different places in the paper where we can read it either way. And I will say there are certainly some people who cite it and use it less as a proof of concept and more as a proof of reality. So to some extent, that's not on you, that's just on others. The other thing I'll say is, I think just as there are probably places in your paper where, you know, like you get more enthusiastic, I think that's true in our paper too. And I think that there are places where we should be and will be. Take your point that we should recognize there are clearly places where insurance can improve risk dramatically, and I think there are probably places where we hide the ball a little bit there, and we will not do that in the final draft. We will revise it to make that clear. And I think telematics is a perfect example. I absolutely agree with you. The evidence is there. In fact, this is a point Peter made. I think this is his very first point to us about we should really be more transparent about telematics and its risk reducing benefit. Actually, someone last year on this very program, and it might have been the author of the paper that you mentioned, Omri. I forget her name. She was at Stanford, I believe, but she had a very good work about the impact of telematics on risk and how effective it can be. So we don't necessarily want to be read, at least I don't think we want to be read as saying this never works or this can't work. I think what we want to be read as saying people have to be a lot more cautious in thinking that this can work, and in recognizing that even when insurance can reduce risk, a lot of times all that's doing is reducing risk relative to what would happen if insurers didn't use these mechanisms, but not relative to a world where there's no insurance at all. I think a lot of times that distinction gets lost when people are talking about this. And to me, that's one of the sort of the key things to recognize. That doesn't mean that sort of reform proposals can never work. But a lot of times if your reform proposal says, well, let's increase insurance and throw insurance at it to reduce risk, that's not a good idea. Now, it could be in certain limited circumstances. So I guess I would say, not only are you not a villain, you're a heroic figure, Omri, in the story, and at the same time, I think that we are working on. You know, this is our first time presenting the paper, and we haven't put the paper out publicly precisely because we know it has a lot of warts that we need to work on, and so. I think an adjustment in the tone to hide the ball less is actually a very good idea and one that we know we need to implement and we plan to implement.
Okay, great. Pat McCoy.
Thanks for the paper. It's really, really interesting to dive into, and there's a lot to think about here. Dan, I wanted to go back to your discussion of climate change, and you suggested that essentially there could be a tipping point or a separating equilibrium between risk reduction and market exit. And you gave that as an example. I'm sure there are other markets where we have a similar concern. I'd be really interested in the paper if you expanded the discussion of what can shift where that equilibrium separates. What makes it more likely for insured to stay in the market versus exit? And in the background is what driving the exit really loss of profitability from risk reduction, or is it concerns about correlated risk? Are there other things going on, let's say in a climate setting, that would lead to market exit? One thing I'll just mention, back a few years ago, one of our specialty journals here at BC published a really interesting piece on the wind coverage plan, I think in North Carolina. And one of the intriguing things that plan did was condition P&C insurers' participation in the entire homeowners coverage market on being in the wind pool. And that apparently worked pretty well to prevent market exits. So it was an interesting way of moving where that equilibrium separates. Thank you.
Well, I have a few things to say. So I actually been thinking about this a bit. Actually, I was just speaking to someone yesterday about this topic. And part of this is actually, so Tom Baker and Anya Shortland have a paper that is related to a lot of this, looking at essentially arguing that to the extent insurers can reduce risk, many of the times where they do it most effectively is with sort of in concert with the government and with government interventions. And I actually think that is one way you can actually have insurers sort of have aligned incentives here. So let me relate it to the climate change point. To me, the best thing we can do on climate change is to get insurers to invest long term in a commitment to insuring a region. Okay. To say, look, if you want to issue insurance now, you have to commit to serving this area for 10 years or 15 years. Or as you mentioned, you need to commit to, for a period of time, serving the residual market. Okay. That then does create some alignment regarding insurers' incentives to reduce risk. And it also creates that alignment on a long-term basis. Part of why I think I meant to say this to Omri too, but I was going on for too long. Part of why I don't actually think that the Florida insurance premiums signal risk to people effectively. It's not just regulation, though that is part of it, that they haven't been able to charge rates. And it's not just that the National Flood Insurance Program is a mess. It's also that insurance policies are issued on a yearly basis. And so any risk, long-term risk, isn't priced into the policy. It's almost hidden from people because people assume they can get insurance now, they can get insurance later. The prices, they don't factor in the risk that the insurance is going to be pulled out from underneath them. So in my mind, one of the things that can be done, and again, to my mind, this is really actually the most promising way to leverage insurers to deal with the climate problem, is to say, look, either as a condition of writing coverage in this region, or in order to actually access subsidies, you have to make some sort of long-term commitment to this region, whether that looks like issuing long-term policies, whether that issue looks like making certain commitments regarding your limitations on non-renewals. That can be debated. Whether that takes the form of carrots or sticks, will give you incentives to make a long-term commitment. Then I think you actually can see some benefits. So you would see some more aggressive action there. Right now, I think to the extent you see action, and we mentioned this in the paper too, it's really focused. Insurers' main interest in climate change is really just to make things more predictable, right? And so they don't love climate change because it makes it harder to predict the future. But that's sort of a second order effect. It's not a huge effect. It's something they can deal with on a year-to-year basis. It's something that creates regulatory challenges for them when they have regulated rates, because they have to convince they have a harder time convincing regulators to allow them to price risk because they can't use historical records. So that's my basic answer. I don't know if Ken wants to jump in.
No, you said it. Said it well. Let's leave time for more questions.
We have 2 minutes left and about 6 people on the queue. So I don't know if Ken and Dan, if you're willing to stick around for another 5 minutes or so after the hour.
I'll stay around for hours.
Well, Kat London.
Perfect timing because I have a class. My question actually relates to when the regulators are actually forcing the insurers to put the regulations on. For example, cybersecurity. When all the ransomware was happening, DFS came out with their framework and said, if you're going to write cyber, you need to make your insureds have the right cybersecurity. And they did it in that kind of, well, we're sort of making you do this. And it was really unclear as you look through the regulations what they're saying you must do versus, and it was kind of fun as a legal intern kind of looking at it going, this looks like you have to do it versus this is squishy. And as someone doing the privacy track at Maine, I had a lot of fun with it. So if you could weigh in there, you've got the regulators saying, no, you need to regulate this, and how that affects the market.
Well, I mean, partly this is just tautological. You know, we don't deny if insurers are made to regulate, then insurance can serve regulation. But that's, you know, that's consistent with our thesis, right? If insurers were told you're not allowed to issue insurance to anybody who doesn't display a valid license every 3 months, then that would have a regulatory effect. What we're suggesting is when insurers try to do it on their own, it's not going to be going to have the effects that some of the proponents of the regulation thesis suggest.
Ray Lehman.
I'll just quickly second what Ken said. And you, by the way, you see this in a number of settings where regulators start saying, gee, insurers are not doing this. We better get insurers to do this, which in our mind is evidence that insurers so you see this in workers' comp. There have been state laws passed requiring workers' comp insurers to issue premium reductions to firms that have had losses, which is odd because actually workers' comp. You see it in auto insurance and Prop 109 in California. Right, part of it was motivated by the idea that insurers weren't giving enough discounts to safe drivers, and so you had a legislative regime that forced them to do it. Also in the context of climate change, some state regulators are saying, well, we're going to force insurers to do this. And we think that can work, but those are very different implications there. You're saying insurance isn't actually on its own going to do this, and we need the state to use insurers in this fashion. And I do think that can work in some settings.
Great. Ray Lehman.
So I've often encountered this question where when mandatory insurance is proposed for problems where the actual issue is a lack of liability. And for instance, the proposals that every cop must have a liability insurance policy, which, you know, leaving aside that cities generally already do have policies, that the actual issue is qualified immunity and the fact that these officers wouldn't be held liable. But then there's the flip side of that. I'm curious what you say is, like, for instance, just this week, San Jose passed this proposal that everyone must have, you know, a liability policy for their gun. It would probably not cover intentional acts, but and we can have a whole different discussion about whether intentional acts are insurable. But the torts exist now, right? People are getting shot. They generally don't pursue a recovery because they don't have an expectation of a recovery. But if everyone had insurance for this, they would have an expectation of a recovery. And in that case, couldn't the existence of insurance provide the mechanism by which the risk can be reduced?
I'll basically say I sort of agree. If I understand what you're saying, I sort of agree with it. I think one context in which mandating insurance does make sense is if doing so allows you to then create liability that you otherwise couldn't create. But that's then a different mechanism as well, right? That's a mechanism where it's not the insurance that's creating the risk reduction, it's the liability. And it's just the only way to make the liability palatable is to add it with insurance. I think that makes a ton of sense. But then actually, in a sense, to my mind, the insurance is a necessary, but in some sense, a risk. It almost mutes. I mean, it would be even better in a sense from a risk reduction perspective. We create liability and we have no insurance. Then cops would be really careful because then it would be their money that was on the line. And so, you know, that's my basic answer there. And I think that's something we discussed in the paper, that is in one setting in where you might want to mandate insurance, even if you don't think it has a net positive effect, because it's necessary to facilitate the creation of liability and to make it politically palatable.
Great. So I think we'll give probably the last question to Bernie Birnbaum. I'm not sure he's still on the call, though. If he is, chime in. All right.
It's Bernie. You got to channel him.
Peter Kotchenberger.
Thanks. I mean, this is a wonderful discussion. I was going to point out the telematics, which has already been discussed. And I think I was really struck when I thought about it, the slides, your earlier slides about what you would need or what you don't have to create the connection between policyholder and insurer in terms of risk-based pricing or else. And telematics may, in fact, provide a lot of that, including the ability to go online and see exactly how your premium was calculated. At least that's the cause. But one other point as well. The residual market idea where you have to participate in the residual market is a good one, and there's nothing startling about that. That's essentially what you have to do in every state for auto workers' compensation anyway. If you're going to be an admitted carrier, you have to pay toward the residual market mechanism in the basis of what you do. So you can get out of it by exiting the market, or you can reduce your subsidy or your allocation by reducing your underwriting. So that's a very familiar feature that I thought was very interesting to bring about. The one thing that I wanted just to mention is, if you can, workers' compensation might be a very fruitful area to explore. You mentioned it, but not only the length and the history of how long it's been going on, it's all about data. I mean, if you can get it, and I know, Dan, you mentioned that at the beginning, it's not easy, but they've been collecting, and some of the same carriers are in the business, they've been collecting massive amounts of data for almost 100 years, because that's the whole nature of workers' compensation. And the thing that sort of intrigues me about that is that I know some companies, Travelers, has gone back and forth between loss control as a measure of underwriting really only, as you mentioned, it can be, not really to enhance the safety, but to understand the risk, to full bore, partnership with the policyholder in terms of making the place safer. I don't know where they stand now, but if you can, they give you a good story as well as maybe some data about that. And then you have the whole FM Global, which stands out as, almost, it's not an example, it's almost an exception to the rule, perhaps, in terms of their partnership with their insurers on building from the outgoing. But I think there's, when you add auto, workers' comp, and maybe homeowners, because while not legally required, it's of course, practically required if you have a mortgage, that's a pretty large segment of the property casualty market that is that is influenced by risk-based pricing as well. Anyway, so those are a couple comments.
I mean, just the one thing I would say is, remember, our point is, look, it's not risk-based pricing is pretty universal in insurance. Our point is risk-based pricing doesn't necessarily equal risk reduction. Okay, there are important steps that need to be taken before you get there. With feature rating, there needs to be causality. There needs to be transparency about how you're pricing. There needs to be control over it. And so, again, I think that, it's true. Yeah, of course, insurers risk-based price, like that's, of course, that's universal. But I do think sometimes there's this sort of, equation of the two. Oh, well, therefore they reduce risk. That's more questionable.
No, absolutely. I agree. I think there's a large market that maybe, that already exists that may be able to evidence that. But you're absolutely right. In the police liability, I put a link to the San Jose, an article on the San Jose law or ordinance that just came out. The thing that's interesting about that is that they're right up front that we know this is not going to address, intentional killings, school shootings, or things like that. That sort of, in my mind, at least in reading it, both the ordinance and the article, is how much they know it's not going to accomplish. But
okay,
so great to see you all.
We are now well over the hour, but we'll maybe try to squeeze in one more question if Dan and Ken have time. Peter Siegelman.
Yeah, so just real quick. I mean, there's a joke that the definition of an economist is someone who, when asked, "How are you?" says, "Compared to what?" So I think you could stand with a lot more compared to what here. And Dan, just in response to your last point, yeah, so risk-based pricing does not guarantee that people are going to reduce risks when they see that there's a higher price. But command and control regulation doesn't generate necessarily the same causal effect either. I mean, you can issue a regulation that says you have to clean up pollution, and that does not clean up the pollution. There has to be a lot of steps in between, and sanctions and penalties and enforcement and inspection and detection and all that other kind of stuff. And so, yeah, I mean, I don't think this is at odds with what you're saying. It's just that, like everything else, the world is complicated, and changing prices, which insurance can do, might or might not be effective, but again, compared to what? And we shouldn't assume that command and controls work perfectly, so that's not the good baseline.
Yeah, I mean, I basically agree with that. I mean, I would say one of our points is one of the things that often is missed is compared to non-insurance. That's one of the things that needs to be asked, because a lot of times people focus on the risk reducing mechanisms and not on the moral hazard, and the two go hand in hand. And so a lot of the proposals out there, with some exceptions, operate on the assumption that there's this net positive effect. And so that's one, but you're right, you're absolutely right. I mean, obviously regulate, and to be fair, right, like going back to Omri, right, like that's one of the points in their paper, right, that like maybe insurance has comparative benefits compared to government regulation. And I don't dispute that. I think that might be true in some contexts. I just think we need to pump the brakes on the idea that insurance can be effective in a wide variety of circumstances. And we're not really engaging in the sort of compared to what analysis or compared to regulation analysis, because that's just a much bigger endeavor than we wanted to bite off now.
Great. Well, thank you for a brilliant presentation.
Yes, thank you.
And
Clap, clap,
thank
clap.
you all for coming. And I'll say this for those of you, it's once we get the warts ironed out, we'll post it on SSRN, and but we appreciate if you want a version now that's warts and all, we're happy to send it to you. But we will have a better version at some point, and we're working on it.
well, hope to see you all next week. Again, for Justin Sidner's Why Health Insurance Consumers Make Bad Choices.
Thanks.
Take care. Bye, everybody. Thanks for coming. Bye.